Please keep your phone on silent too. Kind of interrupts us if we're talking. I'll put mine on silent too. I will tell you that before we start, our presentation is about an hour and 10 minutes long. So just to give you an idea how that's going to work. I really don't stop to take any questions during the seminar. What I have found after doing this for a lot of years, long time, if I'm asking a question and answering a question about you, it really doesn't affect you or you or you, and it becomes very confusing. What I would tell you is we're going along, and even though you may have a question about a slide that I'm talking about, I'm just going to tell you, if you just stay with me, usually the next slide or two, we're probably going to answer your question anyway. At the end of this seminar, if you have a question that I haven't answered, I'm going to be up here afterwards. I'll take any questions, see if I can help you answer that question before you leave. I just don't want to stop as we're going along, okay? So fair enough, everybody? My name is Tim Dern. I'm a local advisor here in the Schaumburg area. I am working with people that are going into retirement or, either in retirement or going into retirement probably 5 or 6 days a week. My office is right across the street from Woodfield Mall. So I am doing this with people at this stage of life, moving into retirement. You'll hear a little bit of 2-minute commercial about me and what I do. Also, I'm a certified financial educator for the Heartland Institute. If you're ever looking for more free information or education, you can go on and look at their website. The Heartland does educational seminars all over the country, and there's no selling. Nobody's trying to sell anything. It's just straight education, but it's a great organization to be involved in. We teach at Harper College here locally at Roosevelt University, so you may see some of my stuff that I'm doing at those local facilities anyway. I will start out by telling you that even in my own practice as an advisor, when I get to people right around this age and they're thinking about Social Security, maybe this is the first time they've ever even start thinking about retirement. So maybe you have not done this yet, and maybe this is the first move for you to start thinking about what's it going to look like when we go into retirement. And if you're a little confused, maybe you're lost, you're maybe unsure, I would tell you that you're normal. This is what most people are kind of thinking about right now as they're going along here. This is also going to be my disclaimer. As an advisor, I am not here today to give you any financial advice. I don't work for the IRS. I'm not a CPA. I don't want to talk to you and give you tax advice, okay? I will be showing you all about Social Security and your benefits. At the end of the seminar, towards the end, I'm going to talk to you if any of you have a 401k or an IRA or a 403b, any kind of a retirement plan. I want to talk to you about when you start pulling money out of these accounts, how that tax maybe can affect the tax on your Social Security. So we're going to do some illustrating if you're somebody who has those retirement accounts, but please don't leave here saying, hey, the guy told me this is the advice, this is what to do, okay? So I'm just saying for illustration purposes. Everybody with me? Obviously, if we were going to make a recommendation with something with you, we'd want to have a lot of conversation with you, but just for illustration purposes, that's how we're going to do it tonight. I will tell you that also being an advisor and along with all the other licenses and certifications that we have to do my business, I will tell you that we do have some expertise in Social Security. I am a National Social Security advisor. So what does that mean? We had to go take a class that was taught by people that worked for Social Security for 34 years. We had to take the course. We had to pass an exam. Right now I am on their website. I am one of the National Social Security advisors. There's not a lot of people that do financial work that have this certification. I just tell you that I did it because when I'm dealing with my clients and they're 62 or 64 or going into retirement, there's a lot of questions about Social Security. So I am a certified instructor. You will hear some of the information that I'm going to give you today about Social Security. I kind of want to set the tone this way. Do I know everything about Social Security? The answer is no. I know a lot, but I don't know everything. I will tell you that you may come up at the end of this meeting and you're going to ask me a question and maybe I don't know the answer to that. And if I don't know, I'm going to tell you I don't know. But I will tell you that I have a whole team of people that work for Social Security that get me answers a lot faster than you can find out on the internet or on the websites. So sometimes it's good to talk to somebody who knows a little bit about this. I think you're going to be glad that you came to this seminar this evening. There are a lot of rules on Social Security, and even some of these rules have changed. So I will set up this meeting by telling you there is one seat over here for you, if we can, or maybe one back there. So Social Security has had some rules that have changed. The reason I say that is if you have somebody older than you and they turned on Social Security and they've been collecting Social Security benefits, and maybe they did one of these switch strategies between a husband and wife, I will tell you that you can no longer do that anymore. So I talk sometimes, even in my own practice, people say, you know, my sister, she used to tell me that you could do this, this, and this. You'll see that some of these things have changed. I also want to make mention that it is kind of, be very careful where you get your information for Social Security before you make your decision. A lot of people are going on the internet, reading something that's old. They think they can do something one way. That's not true anymore. A common thing that happens to me, I see this quite often. I'll have a client in my office and we'll be talking about their financial plan and their retirement, and I'll just make a comment to them and I'll say, hey, I noticed that you turned on your Social Security at 62 and you're still working. You look like you have plenty of money. Why did you do that? Just curious. And it's usually something like this. She may tell me, well, you know, my sister, she said, go in there and get your money. That system's going broke, man. You better get your money. Get your money while you can. And then I always kind of do this kind of stuff. I say, your sister works for Social Security? Oh, no, Tim, she works at Macy's. But she's on the internet and she saw and she did and whatever. And I cannot tell you how many people have made a Social Security decision based on what they heard or what they saw. And you're going to find out today that your decisions matter, and therefore the rest of your life. When you make a decision, there isn't like a do-over situation where you can change this. So we want to make sure that you completely understand a lot of these things before you make a decision. How many in here have not made a decision on Social Security yet? You're not claiming. How many already have? Okay, so if you've already claimed a Social Security benefit and you hear some of these strategies and some of this stuff, you're probably not going to be able to do anything about that, because once you start claiming on a Social Security benefit and you've been collecting at least 12 months, you can't change. So the ones of you who have not made a decision, this will be very helpful for you to help you make a decision. I like to tell this before we start. It always kind of amazes me when I talk about Social Security. Do you really know what you think you know? People come to these classes, to these seminars, and they've kind of been all over the web. They've done some homework, and they think they really know it's this way, when in truth it's not that way. But you're convinced it's this way, and it's not. So I tell people this is a big decision, and make sure you know. I want to do a quick 1-minute exercise to make this point. You'll get this real quick. On what people think they know is true really is not true. So let's just play along with me here for 1 minute. If you can just shout out the answer if you know it. If you can think of a stop sign in your mind, how many sides to that stop sign? 8. What color is that stop sign? Okay, everybody's cool on that. How about a yield sign? How many sides?
3.
What color is it?
Yellow. Anyway, it used to be yellow.
Listen, I get it. I'm 62 years old. That sign was yellow when I took driver's ed. But look at this. It's been red for 32 years. How many know you're convinced it's yellow, but it's red? Get the point? As I start to go along on different things, I'm going to revert back to, remember the yield sign, because it makes a point on what we're going to talk about. All right, so let's start out just talking about Social Security. And who can tell me? This is just kind of general information. Who knows when Social Security was signed into law? Anybody?
No idea.
August 14th, 1935, President Roosevelt. I was explaining this to my son the other day. He had no idea who President Roosevelt was. Our history books, I guess, are whatever, right? Here's a couple of interesting things about this when I did some research going into learning to get certified for this. So in 1935, when President Roosevelt signed this into law, a couple of very interesting points. This was going to start when people turned 65. So the idea was when people 65 start to retire, we'd give them some money to keep them out of poverty, not to retire with a big, healthy sum of money, just to make sure people aren't really starving and could get along. But when he signed it into law and it was going to start at 65, the life expectancy of a male in 1935 was 66 years old. A female was 68. So how long did they intend on carrying people into Social Security when this all started? You get the idea, not very long, right? How many know today we got people living well into their 80s, into their 90s, and more people coming on? Do you think that Social Security is being overloaded with all these baby boomers coming on? And the answer is yes. Do you think Medicare is being overloaded because all these people are coming on? The answer is yes. And this is putting a real burden on this system, so they had to make changes. And will they have to make changes in the future to keep it going? And the answer is yes. So hopefully as you're going along, you're going to learn something tonight for our age group. But I think about my children and where their Social Security benefits might be, who knows? This could be different for our kids coming up. But anyway, that's the interesting thing about that. So I know somebody in the room here has done this. You've been on the internet, you've seen it, you've done the math. When is the best time to collect Social Security? When do you say?
When you're dead. That's when you do.
70? Okay, so you got this, right? Somebody's done the math. They've been on there. You can start as early as 62, but sometimes when people think they got the answer. So here's what I'm going to tell you as an advisor. This is what I tell all my clients when the perfect time is to collect Social Security. There is no best time. This is a very personal decision. Don't let anybody tell you that's the best time when you should go in. You should go in and get that money at 62 because that system's going broke, and so on and so forth. What we like to say is it's a personal situation. Some of you people in this room, Social Security might be the only money you have going into retirement. That's all you have. You may have to turn yours on early. Others, you may be working well at 65 or 66, and maybe you have pensions or IRA or other money. So it is a situation that's personal, and every time I meet with a client, it's a personal decision depending on what the situation is for them. So just understand that. Now, we are going to talk about these benefits, and I want to start out by who's eligible for Social Security. And the first thing I would tell you about this is Social Security is not a welfare system. You've had to pay into this system to get money out. So if you've been paying in by FICA, how many of you know FICA? It's coming out of your paychecks, right? What is that FICA thing? So if you've got FICA wages and you see FICA coming out of your check, you've been contributing to Social Security and Medicare. Now, you have to reach a certain age to get eligible for Social Security, so you have to age in. You could have a spousal benefit. Now, what this means is you could be not even born in this country, maybe never worked a day in this country, never paid in $1 to Social Security. But if you married somebody who did and who is collecting a Social Security benefit, you'll be entitled to a spousal benefit. We'll explain how that works. If you've gotten divorced, can you claim on an ex-spouse? We'll show you how that works. Maybe you have a deceased spouse, a widow or a widower benefit. We're going to explain that. Dependent children. If I died and I had dependent children at home, my wife could collect a survivor benefit from me. I also could get some money for dependent children. This is usually children that are less than 16 years old or still in school. There's some rules and regulations on that we'll talk about. Maybe you're taking care of a dependent parent. You're the only help that this parent might have. If you've died, there are some benefits that can go to help take care of a dependent parent. We'll explain. There's also disability. People can come on to Social Security through disability. So let's start there. Let's talk about a disability benefit. If you're in the room and you're currently collecting disability, and however you got there, and just as a side note, if you're collecting disability for 24 months consecutively, you'll be eligible for Medicare. But if you've been collecting disability for quite a while, and sometimes we talk to people like this, they say, what happens when I turn my full retirement age and I become eligible for Social Security? What's going to happen to my disability benefit? So usually what we see, and this is not in every single case, but in I'd say 95% of the cases, you're collecting disability. When you turn full retirement age, you'll stop collecting disability, and now you'll start collecting Social Security. It should be the same check. They're paying you out of one bucket while you're disabled. When you reach full retirement age, now they're going to pay you out of a Social Security bucket. But usually what we see is it's the same money, so just to start there. I will tell you that a lot of people get to this time in their life and they start looking at the Social Security benefits and they find that's not enough. How can people live on Social Security? This is going to really affect the people who are high earners. If you're somebody who makes good money and you're used to making a good paychecks and then you see your Social Security benefit, you may say, how am I going to live on that? You may have to make some adjustments, or you may have to keep working a little bit longer. And I will tell you that we're seeing more and more people deciding to keep working a little longer because they can't live just on the Social Security benefits. Now, maybe you got some other nest eggs saved up, so maybe you have some other savings. This is going to play into your retirement, and we're going to show you some things that you should be concerned about with your retirement plans at the end of the seminar and how that works along with your Social Security. I would start out by giving you this thing to think about tonight as we talk about this. This is something I do with a lot of the education I do around and teaching courses, and I do this in my own practice. I talk about 3 phases of money. The first phase is accumulation. So accumulation is when you're working, you're getting a regular paycheck, you're contributing to a 401k, you're on the way up here. You're just kind of saving money and continuing to work and everything's hunky-dory, and you don't really need a very strong financial advisor to buy you a basket of mutual funds for your 401k when you're contributing. But there's going to be a day when you plant your flag and you're going to say, okay, I'm done, I'm retired, and now you're going to start not getting a paycheck at work. You're not going to get health insurance at work. You're going to start living on Social Security. You're going to start pulling money out of your 401k or IRA or whatever investment do you have. And I will tell you that this phase is different. Way different than this phase. Just to give you one idea, if we're concerned about risk in the market, a market correction, when the market corrected in 2008 and people lost 50% of their portfolio, if they were still working, they were upset, but it wasn't devastating. But if you were 69 years old in 2008 and that market lost 50% while you're pulling money out, do you think it was a different ride for those people? Absolutely. So I want you to start thinking about the distribution phase, because that's what we're going to talk about tonight. This is what I do in my practice. We are distribution advisors. If you've got a young advisor out there that really is understanding everything about going up and accumulating, when you get to the end, they may not know some of the stuff I'm going to talk to you tonight. The difference to you, it could cost you a lot of money. We'll show you. So let's just start out by talking about going into retirement. Social Security and pensions used to be how people retired. You know, my parents and a lot of parents that I know before me being the parents retiring, I don't remember that generation saving for retirement. What happened is they worked really hard, but when they finished work, they just got a pension. They got the same amount of money and they just kind of went into retirement. They got Social Security benefits and a pension. But the Social Security right now is not really enough money sometimes to live on, and pensions are shrinking. Some people still have pensions, but they're shrinking. What has happened is the employers now have gone to these contribution plans, 401k, meaning you got to decide to participate. You got to contribute. You got to manage that money. It's a different ride now. So as you're trying to get your money together at the end, the onus is more on you. It's not necessarily the pensions. What I find in retirement is people are burning through a lot of their own personal money, and we want to be careful about how that works. Just to make a mention, we like to talk to people about a written income plan. Social Security will be a part of it. But if you do start putting a plan together and how you're going to live in retirement, and Social Security will be a piece of it, the people that have a plan and they kind of really know where their money's coming from, they live in a better peace than somebody's going to have to watch the market all the way through in their retirement. So I'm going to give you a 2-second commercial about us. This is me and my partner, Sean. We do all kinds of stocks and bonds and all kinds of investments. Everyone that's kind of in the Schaumburg area, maybe you know where Woodfield Mall is. My office is across the street from Woodfield Mall. But we've been doing independent advisors for a while. The thing I would tell you is we're fiduciaries. If you're out there talking to an advisor, ask them if they are a fiduciary. Simply, the fiduciary means when we're in our business, if we're managing your money, we get fees on that. We would explain how that worked if you became one of our clients. But who's ever managing your money right now is getting fees. Sometimes you're getting commissions, depending on what they are. The fiduciary says, I can't make a recommendation to you based on my pocketbook, my fees, or my commissions. I have to do something that's in your best interest, and I have to show that it's in your best interest. And if you worked with us, you would understand that. But it's nice to know that somebody's on your side if they're talking to you, because this is very complicated when people look at this. We do a lot of educational events at our company. In our firm, we're out there talking about Social Security, like tonight. We are talking about Medicare. We're doing Medicare seminars, educating. If you think Social Security is confusing, wait until you see Medicare. We also do a lot about retirement planning. And if you're interested in seeing some of those seminars, you've got my little sheet here. You can look at my website, and you can go on my website, and you'll see all the free educational events we do in the area, so you can check them out. But a quick word about Medicare. Even though we are not going to talk in details about Medicare, I want people to understand two very important things about Medicare. First of all, you enroll in Medicare when you're 65, unless you came in through disability. But most people are going to come into Medicare when they turn 65. And you're going to sign up for a Part A, and you can sign up for a Part B. Now, what's a little confusing, and I just want people to be aware of this, when you're turning 65, you are going to get bombarded with mail. You are going to be cold called to death. Everybody that's involved in Medicare is going to call you, and and everyone's going to tell you you have to sign up for Medicare, and you're going to get notices in the mail. Here's what happens. When you turn 65, you're eligible for Medicare. You should sign up for Medicare Part A. It's free. Medicare Part B, there is a cost to Medicare Part B. Somewhere around $135. It'll be determined by how much money you make. We could explain that later. But Medicare Part B, you do not have to sign up for, even if you turn age 65, if you're still working and you're covered by health insurance at work. Even if you're a spouse who's not working and you're 65, but you're covered by a spouse's plan at work. So the rule is if you've got health care coverage through work, even when you turn 65, you do not have to sign up for Medicare Part B. When you leave work, and that could be at 70 years old, you can leave work and say, now I got to sign up for Medicare Part B. They're going to just tell you when you go to sign up for Medicare Part B, they're going to tell you well, how that works. You're going to have your open enrollment window. The Medicare options, the Medicare Part A and Part B only cover 80%. Medicare Part A covers the facilities, hospitals. Medicare Part B covers the doctors, the lab tests, things of that nature, but it only covers 80%. Where it gets very confusing is you have an option, either this path or this path to cover the 20%. So if you take the Medicare and then you got Medicare Part A and Part B, and you want a supplement, these are the ones that with the letters, they're F, G, N, a Medicare supplement. You go to any doctor, anywhere in the country, anybody who accepts Medicare, you're going to be covered. There's no networks on that plan. You will pay a monthly premium for your Medicare supplement depending on your age when you come in. And if you take the supplement, you are going to also have to, let me say this, you're going to also have to, government's going to make you sign up for a drug plan. How wonderful is this? If you don't sign up for a drug plan, you will be penalized every month for every year that you don't have a drug coverage. So the scary part is sometimes I have a client and they may be 70 years old. They signed up for a Medicare supplement early on, but they didn't sign up for a drug plan because they didn't take any medication, they didn't need it. Now they come in at 70, now they need some medication. We have to sign them up for a drug plan now, and now they're paying a penalty that's been 5 years building, and that stays with you for the rest of your life. 21 different companies in the state of Illinois are competing for your business. All of them, there's 21 companies that sell a Plan F or a Plan G or a Plan N. Do you think they're all the same price? They're not. So when you get ready to shop for this, you better know somebody like me who can help you determine what might be the best for you. If you don't want the supplement version, you can get on what they call an Advantage plan. This is a 0 premium every month. So you're not paying a premium every month here. You will pay a little bit out of pocket as you go use services. This is an HMO or a PPO network. So you're going to be considered within the network. If you want to get care outside of that network, you're going to not get cost covered by an Advantage plan. So you better be very careful. If your doctor network is in here, you're going to love this plan. But this usually includes the drug plan, and it usually covers other benefits, like sometimes dental and glasses and a few things like that. So the point I want to make to you is some people are choosing this route and some people are choosing this route. And do you have to stay with each route for the rest of your life? The answer is no. You can move back and forth. We can explain there are some restrictions that you need to know about, but you are not having to stay on either plan for the rest of your life. In my practice, we are certified to do supplements, we are certified to do Advantage plans and drug plans. If you contact an agent who only does one thing, then this is what you're going to hear about. So I would just encourage you, if you're want to know about Medicare, talk to me further about that, or make sure you talk to somebody who does that. You might have seen us on television. We've been on a lot of the local TV. We did a lot of cable shows. We've had some exposure out there. My partner Sean was on Your Money Matters for a while there. We were doing that show. I've been on Channel 7 quite a bit, Channel 32. We've done a cable show here in Chicago at the Options Exchange. I put this in here because this is my office building. Now listen, obviously we meet people at these meetings and some people want to come in and talk to us. Beautiful, we'd love that. We don't charge for that, we'd welcome you to come in. But the reason I put the building is because they know I'm at the Woodfield Hyatt, and sometimes they come to my building and they call me, "Where are you?" "I'm in the Hyatt." I said, "Well, I'm in the building next to the Hyatt." So I'm on the 9th floor of this building next to the Hyatt, not in the Hyatt. That's just kind of how that worked out. We used to give out maps and stuff. Anyway, enough of that. Let's talk about Social Security. So first of all, somebody in the room tell me, is Social Security broke? How many say yes? How many say no? How many don't know? Okay, so let's solve this right now. The Social Security system is not broke, not for baby boomers. Don't let your decision to collect early on your Social Security benefit be because you think the Social Security system is broke. That is not true. We're going to be fine for baby boomers. Now, there is going to be a problem. Right now, they're going to be short in 2034. They already know it. We're going to run out of money in 2034. Social Security benefits are going to reach $1 trillion within the next few months. How do you like that? $1 trillion of benefits paid out. This is going crazy, right? Anyway, in 2034, they know we're going to have a problem, so you're going to see they've made some changes, and they're even considering making more changes. Why? Because if they don't, we're going to run short. How many think, whether you're on the Republican side or the Democrat side, how many know whoever's in office in 2034, and they have to announce that we're taking 1/3, everybody on Social Security is getting paid 1/3 less. How many think that will be very popular? That will be a disaster. So obviously, they know they're going to be short. They're making some moves. I'll show you some things that they're doing and potential things they're doing down the future. But really, this is going to affect our children. This is what's going to happen. So let's talk mostly about I want to make sure everybody understands their Social Security benefit is guaranteed for life. If you turn on a Social Security benefit, you are going to collect that benefit until you die. It's every month until you die. Who in the room knows what a death benefit is? If I'm collecting Social Security and I die, what does my wife get on a death benefit for Social Security? Anybody know? How much? He's correct. $255. Doesn't that? Who come up with that number? It just sounds so weird, you know. Oh, here's $255 to the. Your spouse gets a $255 check. I just can't even believe what we're supposed to do with that money, but that is, it used to be $250. They raised it to $255. Wow. Anyway, you may get an inflation-adjusted, COLA-adjusted, collecting your Social Security, you may see a little bit of a raise. The last one we got was 2%. So you may see your Social Security is increasing a little bit, but don't expect it to go real big where you can take many trips to Hawaii. Here's the thing I would have you consider. Your Social Security is a tax-preferred asset. This is very important. The way they're going to tax your Social Security money is not the way you're going to pay tax on your retirement money. We're going to explain the difference here, but the thing I'd like to have you start to consider, we see in our practice when people are working and they have a nice 401k or an IRA and they want to quit work early and retire, they're going in and quitting work early and they're collecting their Social Security benefit early, delaying their 401k or IRA money. And we want them to reconsider that a little bit because we think we can show strategies where if you want to quit work early, claim on your retirement benefits first, let your Social Security delay. One is a taxable asset anyway. This is a non-taxable asset. One is guaranteed, one is not. We're going to show you when we start talking about strategies. It will open your eyes and make you rethink about how you may want to do that. It is income for life. Okay, this is the part where you got to start taking notes. This is the important part, talking about your benefits. So we're going to start this way. We are going to tell you these are two things that you need to know about Social Security. And this is important. If you want to start talking to the Social Security Department or you want to start going online, you need to know FRA. You need to know PIAA. These are two things that people are going to talk in. So this is a weird jargon. This is a weird language, but you're going to hear this. So the first thing, the full retirement age. The second thing is the primary insurance amount. So let me explain. Your full retirement age is going to depend on your birth date. So whenever you were born, so for instance, if you were born in 1943 to 1954, your full retirement age is 66. Pretty simple. But if you're like me, I'm born in 1956. I'm 66 and 4 months. You'll see 66 and 6 months, 68 months, 66 and 10 months. You can see that we're pushing down from 65, are we not? Already to 67. My partner, who is only 30 years old, he'll probably have to be 75 years old before he collects a Social Security benefit. But that 66 and 4 months, does it matter? It matters. By the way, this chart is in the book you have on the inside cover of the back page. You'll be able to take a look and find your birthday. You'll know when your FRA is. The second part of this is the PIAA. This is the amount that you're going to get on your check, what they would pay you every month on your Social Security benefit at your FRA. So let's do this. The PIAA is what you get at FRA, if everybody's with us on that. So the PIAA, how do they come up with this amount? Well, first of all, you have to have at least 10 years of working, 40 quarters of paying into Social Security. I had somebody come in my office just on Monday. They worked 9.5 years. She's telling me, Tim, I worked 9.5 years, for crying out loud. I said, well, I didn't make the rule. I'm just telling you got to work 10 years. So go find a job, work 5 more months or 6 more months. Once you have 10 years in there, you'll get a Social Security benefit. But if you don't have at least 10 years in, you will not see a Social Security benefit. So if you've been working your whole life and you've been paying in all your various jobs, they're going to take the top 35 years of earning. So maybe you got 45 years of working. They're going to look for the top 35, and they're going to come up with averages, and we're going to show you how they're going to create how much do you get in Social Security. I want to make a point here, though. For me, my first jobs, I was working at McDonald's. I was a waiter. I did some of those jobs. They're part of my 35 years. Now I'm making a lot more money. Some of these years I'm working right now are replacing some of my weaker years. Why is that good? Because it's raising my overall average, so I get a higher benefit. If you're somebody who maybe was working and then you stopped working, maybe to raise kids, and you started working again and stop, maybe you're working later in life, people come in, should I keep working? Depends if you don't have a good record, and maybe the money you're making is good right now, you may want to keep working because you're going to increase your overall average. And it helps people get a higher benefit when it comes time for Social Security. This is where you find out what you're going to get. This is where you find out information about your benefits. Now, you can get this mailed to you, but if you're not getting it in the mail and you want to go online, you go to the government website, ssa.gov. You're going to click on this button. It's going to say create a new account. You're going to click on that button. It's going to ask you your name, your Social Security number, your address. You're going to be really surprised on how much information they already know about you. It's already in this system. But when you log in and you open up your account and you're in there, you're going to find out all your earnings records. You'll see what your disability benefits are, what all your Social Security benefits are. You're going to see a lot of information. You're going to get sample statements. You can see all the years that you filed tax returns. And if you said, I worked in 1989, and right now they have a 0 on my record, and I know I worked, if you can prove that you worked and they missed it, they'll increase that number and they'll put that number on your books. But they're pretty accurate. I find that they're pretty accurate on that. What you want to find is you want to find this page. When you get through that account and you're looking around in there, you want to find this page. It's called the Retirement Estimator. This is going to give you an idea of what you're going to collect on your Social Security benefit. So you're going to see what you would collect at full retirement. You'll see what you would get if you went early at 62, and if you delayed all the way to 70, you're going to see 3 different amounts. It's a little bit confusing for people, but this is the first step. If you're working with someone like me as an advisor and we're trying to do planning for you, we need to know what these Social Security benefits are, and we need to talk a little bit about when your timing of this is, so we can talk about what kind of money you might get. So let's put this in perspective on this chart. This is also in your book. I'm going to explain to you on your full retirement age, I'm representing your Social Security with a 0. Meaning if you collect Social Security at full retirement age, there is nothing subtracted from your benefit. There is nothing added to your benefit. But if you look at this, if you collect Social Security at 62, they're going to take 25% out of your check. So if you were making $1,000 a month here and you collect early, you're only going to get $750, and that's for the rest of your life. And that's for the rest of your life. I have people that come in my office. Oh, yeah, I heard I could change that. Yeah, when I get to be 67, Tim, I'm going to change that. And I kind of chuckle. How do you change it? And they say, you can't change it? I said, no, you can't change it. You're locked in. Now, look at the closer that you collect, going closer to your full retirement age, you're going to notice that they withhold less. So maybe it's not as severe. But look at what happens if you don't need to collect Social Security at your 66 or full retirement age, and you can delay even 1 year. Maybe you're still working. You don't need to turn your Social Security on. They're going to give you an 8% increase for the rest of your life. You delayed 2 years, 16% increase for the rest of your life. Now let's just stop here for a second. I'm in this business. You tell me the investment that you have that gives you a guaranteed 8% increase for the rest of your life, or 16%. Tell me the one that's guaranteed. Because now I start thinking about, wait a second, maybe we delay Social Security, maybe we pull from IRA, and maybe we do some timing here because it really matters later in life. You can delay all the way to age 70, but after 70, there are no more increases. So there is no more reason to delay past 70. So just so you're with us. These are called delayed retirement credits, DRCs. That's why we have them in green. We want to pay attention to this because when do these DRC credits apply matter, and people have this confused. So just to give you an idea how this works, if I was collecting $19.80 at 66 and I went early, it's $14.50, a difference of $500. Here's what I want you to think about. It's $500 a month. So let's just do this. $500 times 12 months, $6,000. Everybody with me? 10 years in retirement, 60 grand. 20 years in retirement, $120,000. Get the idea? Those $100 really add up depending on how long you're going to live in retirement. It matters. So a little planning. Look at the difference between going early and going late. It's a 78% increase, guaranteed for life. So when you get down to thinking about how do you want to collect your money, you might want to have some conversations with somebody who understands this and figure out, along with your other retirement money, how this might play out for you. It matters. All I'm going to show you is just a couple of slides that says if you were making $50,000 a year and that was kind of your career, so remember the 35 years of earnings, if you had 35 years and at this is what your numbers would look like going early or going late. If you go early, if you go at full retirement age, or if you go late, just to give people an idea on how they work. The difference between going early and going late, just over 10 years, look at that. That's $126,000 in 10 years. Does it matter? It matters to people later in life. People that go early wish they would have waited. Medicare prices start to increase later on in life. You're on fixed income. Some people are better off, wishes they would have waited. So we'll explain some of this. This is another thing that you got to make a very important note of. This is very much a reason that we see people getting into trouble with Social Security when they claim early. So let me make sure you get this. If you claim your Social Security early, this is any year before your full retirement age. So this is any year before full retirement. And you're still working. You're going to have an earnings test. And if you go over how much money Social Security says you can make while you're collecting, you're going to have a big penalty. I see this every day. Almost every day in my practice, we see people coming in like this. This earnings test applies if you're collecting Social Security and you're still working. So let me show you how this works. And this is going to be, I'm going to do my own benefit. So remember, I was 66 in 4 months. So let's say I started collecting Social Security at 62 and I'm still working. How much can I make a year? $17,640 a year. So if I'm collecting my Social Security benefit, I can't make any more than $17,000 or I'm going to have a penalty. Where it gets kind of crazy is people say, well, what can I make at 63? $17,000. What can I make at 64? $17,000. What can I make at 65? $17,000. What can I make at 66? The year I'm turning full retirement age, they let me have an increase. Now I can make $46,000. But the month I turn 66 and 4 months, 66 and 8 months, whenever you turn full retirement age and you're still working, there is no earnings test anymore. So first thing I talk to people when they start saying, I want to collect Social Security early, my first question is, you still working? Well, yeah. I had a gentleman come in my office. He was collecting his Social Security early. He's making all kinds of money. I said, why did you turn that Social Security? And he goes, hey, Tim, I got this great idea. I bought a condo in Florida. That Social Security is paying that mortgage. He's like this, huh? I go, well, you know, you're going to get penalized here. He's like, what are you talking about? So here's what I had to start to show him. And by the way, what's not included in the earnings test? So if you're collecting Social Security and you're working, what's included are wages, any kind of wages, commissions, earned income, bonuses, severance pay. This is included in that earnings test, not just your salary. It's everything you make. What's not included? IRA distributions. So if you stop work and you're collecting Social Security, but you're drawing on an IRA, that doesn't count on the earnings test. So there is some timing to this. Your investment income, your pensions, rental income. Look at this. You could win. You can only make $17,000 unless you win the lottery. I just think this is so strange. There were almost $1 billion in that lottery winning last time, right? You could have won $1 billion. It does not affect the earnings in your Social Security. I just think this is hysterical. But $17,000 if you didn't win the lottery. But this matters to people. Here's a real life situation in my office. I have a client working, 64 years old. She was collecting Social Security since 62. Now remember, this particular lady understood when she goes early, she could only make $17,000. So she pulled back from full-time work. She went to the company and they pulled her back. But she's kept working for 2 years and got caught up, and pretty soon she's doing this and then doing that. And So at 64, she makes $60,000. She can only make $17,000. She's $42,000 over the penalty. Now here's the shocker. You got to write a check to pay back $21,480. How many want this?
Wow.
Right? Now listen, if you don't write a check and pay back that money, they're going to stop paying you your Social Security. They're going to hold your Social Security until they collect that $21,000. Does this happen? All the time. People don't get it. Now, if you got advisors or you're over here at one of these companies, they don't understand this either. They're going to tell you, and everybody all of a sudden, now how this happened, this is a client of mine. Now, she's got money. We're managing money, doing some things with her. She called me one day and said, they stopped my Social Security. I don't know what happened to my Social Security. Well, what am I going to, I'm already thinking this, right? I said, are you still working? Yeah. How much did you make? I don't know. I don't remember. Well, come on in. They stop your Social Security. Now, I want you to know something. They're going to stop paying your Social Security early. They're going to put all this money back into your account. They're going to hold it for you until you turn full retirement age. They're going to recalculate your benefit, and they're going to turn you back on at full retirement age. So I don't want people to think they're taking the money away from you. But this is one of those pushback deterrents to say we need our money. In other words, if you need the money and you're going to stop working, we're going to give it to you. But if you're going to work and you're going to still collect on the money, they're going to push back because they need the money for someone else. This is one of the first big ones that's happening. And this happens a lot. So if you're somebody who is going to turn Social Security on early, make sure you understand the working and where you're pulling money from. It's very important. Let's talk real quick about Social Security benefits for married couples. A spousal benefit. So, me and my wife are married. My wife has the option, when she gets ready to collect Social Security, she can collect her own Social Security benefit, or she could collect half of my benefit. So if I was getting $2,000 a month and my wife wanted to collect half of mine, she would get $1,000 a month. It does not affect my benefit. I get my $2,000, she gets her $1,000. But she has to decide, does she want her own or half of mine, not both. A lot of ladies want both. Here's the other thing. If you take yours, you're locked into yours. If you take half of mine, you're locked into half of mine. There is no switch strategy anymore there used to be. You may have heard people older than you, hey, we used to turn this on and turn this off. I spare you the details. Another one of those pushbacks, they cut it off. Why? Because they need the money. So the key to this is if my wife wants half of my Social Security benefit, here's a couple of things that you need to know. If she's full retirement age, she gets the full half. If she turns on at 62 and wants half of my benefit, she's going to get 25%, 30% less than half. So anytime you turn a Social Security benefit on early, you're going to get a reduction, and you're going to be subject to the earnings test. So watch this. She tells me today, if she wanted to, turn your Social Security benefit on at 62 so I can collect money. Well, then I'm subject to the earnings test, and I'm subject to less money. This is now, the strategies are different. So the DRC credits do not apply on a married couple. So let me explain this. Remember we talked about PIAA. My PIAA, let's just say, is $2,000 at full retirement age. And I delay all the way to 70. And let's say I delay it in my, with the credits, it's $3,400 now at 70. Not $2,000. I'm getting another chunk of money, whatever it is. My wife wants half of my money. Does she get half of the $3,400? Or does she get half of the PIAA? She gets half of the PIAA. So she doesn't get half of the delayed credits, it's just half of the PIAA. So make sure you get that. All this is just showing an example how they don't apply. Let's talk about survivor benefit. So who knows right now, if me and my wife are married and we are both collecting Social Security, we're not yet, but if we were, and one of us dies, what happens to the Social Security benefit? Anybody know? Okay. You're going to get the higher of the two. The survivor gets to pick the higher of the two, but not both. So watch this. If Bob and Lisa were collecting Social Security and Bob dies, Lisa would switch to his benefit, the higher of the two. That's the good news. The bad news is she's going to lose her own. Again, a lot of people think they're going to get both benefits until they die, and that's not true. This is where planning comes in. This is where I talk to people and say, listen, what other monies do you have? Because when we start building guaranteed income, if somebody dies, how do we replace the $1,200? It's very important. But the thing that's here, these delayed retirement credits now do apply. So if I had delayed my Social Security benefit to 70, and it's $3,400, and I die, my wife gets the higher of the two, and she gets the $3,400. So a lot of times our strategies between husbands and wife is one should go early and one should delay. Why? Because the survivor, unfortunately, statistics show, guys, the men are going to go first. And I didn't write the book, that's just kind of how it's working out. So if I delay a little bit longer, then my wife could get a higher benefit. Okay, so just know that. What about a widow or widower? I don't want to go into a lot of details here, but this is the only person who could do a switch strategy. If you're married and your deceased spouse was eligible for Social Security, you would be able to either collect that first, delay your own, or collect your own, delay that, and you could switch back and forth. I don't want to get into details, but if you are a widow or a widower, you maybe want to talk to us. The key is you got to be 60 years old to collect that benefit. So if a lady comes into my office and says, Tim, my husband died, I want to get his Social Security benefit, and she's 58 years old, I say you got to wait until you're 60. When you're 60, you're going to be able to get that. But you do have a switch strategy as the deceased spouse. Can an ex-spouse collect on a divorcee? The answer is yes. So let's just say got a husband and wife married. And like my wife, when we were kind of got married, she was working, we had kids. She didn't work for many years raising the kids. So then she went back to work. So obviously her record is not that high. If we get a divorce and I go over here and I get married, can she still collect half of mine? The answer is yes. She can either collect her own or half of an ex. What's the rule? You got to be married at least 10 years. Again, somebody comes in my office. I was married 8 years. I didn't make the rule, but if you were married at least 10 years and you've been divorced at least 2, can I go collect half of my ex-spouse's benefit because I don't have a big enough benefit? The answer is yes, but again, not both. You're either going to collect your own or half of your ex. So, and it can work either way if people are married. So something to learn about. Last two things I want to make mention about is something called the WEP, Windfall Elimination Period, and something about GPO. These have to do with your getting pensions. This really refers to school teachers. School teachers in the state of Illinois are not participating in the Social Security program. They have their own retirement pension. There's other government people that are getting different kinds of pensions, and they could offset Social Security benefits. So if you have a government pension or a teacher's pension and you want to collect some Social Security money, there's going to be an offset to what the amount would be. Quick example is if I have a husband and a wife, the wife's a teacher, and she married somebody and her husband dies and she wants now his Social Security benefit, they're going to say, what do you make on your teacher's pension? If she says it's $7,000 or $8,000, because a lot of these pensions are huge, they're going to say you make too much money, you don't get any money. It's an offset to Social Security. Now, if you make less or different things, but there are these things, these again, if you have pensions, not every company pension, these are government pensions. Sometimes this works. But again, if you have a pension, you might want to come talk to us about some of this. Let's talk about taxes. You're not going to understand all this on taxes, but I'm going to try to explain two things that you need to know about taxes. And if you're somebody who has other retirement accounts, you're going to want to really be careful when you start pulling money out on how this affects Social Security. There's a provisional income formula. It takes your adjusted gross. They're going to count half of your Social Security benefits in this formula. So again, an example, me and my wife, if I make $20,000 a year Social Security benefit, she makes $20,000 a year Social Security benefit, total $40,000. When I go to do my taxes, we only count half, $20,000. Not $40,000, $20,000. Half of our Social Security benefit. So if I'm filing single, and they're going to count, half of the Social Security benefit, if you make less than $25,000, there's no tax paid on your Social Security. If I'm married, so just watch this. If I made $30,000 a year Social Security benefit, my wife makes $30,000 a year Social Security benefit. Everybody with me? That's a total of $60,000. When I go to file taxes, they take half. So I could literally make $60,000 a year with no income tax on my Social Security benefit. Now, when you plan this out, if you have retirement money and you pull money out of an IRA or 401k, got to pay tax, yes or no? Of course you do. You didn't pay any tax putting the money in. So some of these taxes that are going to come. Now, the good news about the state of Illinois, we are one of the highest tax states ever in the history of the world. But state of Illinois is not going to tax your Social Security and not going to tax your pension. They're not going to tax your retirement money. Isn't that wonderful? But the federal government is. So is there a formula you need to know? Yes. And by the way, if you're a high earner and you make over this, you're going to see that 85% of your Social Security benefit could be taxed. That is not an 85% tax bracket. If I'm a high earner and I come into this bracket, let's just say I make $1,000 on Social Security, $850 is going to slide over here into the taxable column. I'm going to pay tax on that at my ordinary income rate, whatever I'm making it that year. But 15% of your Social Security can never be taxed. Maybe 50% can be taxed, and some of you won't pay any money on your income tax. Thing I would tell you when we start doing planning with people in our office, if you time this right and do this right, you can make a lot of money in retirement, pay very low taxes if you understand how to work this. File and suspend strategy, it's gone, so I don't want to talk about it. There is a switch strategy today. If you've been born on January 1st, 1954 or earlier, there still is a strategy you could switch between a husband and wife. We can talk about that at the end. Just to kind of review, a little bit of planning matters. 2/3 of our filers go early, even whether they need it or not. People are going in and getting their Social Security. And then they're still working and they're finding out, oh my gosh, I can't make as much money as I thought. So just understand this is happening. It's a tax-preferred asset. You should start really thinking about how this works. If you go collect on a Social Security income first, you're sort of beating into a tax-preferred asset. You're reducing what you could make for the rest of your life, and you're deferring an asset that's highly taxable and not guaranteed on your retirement money. So there's some things that we need to talk about on this. I don't want to go through all these, but we're just showing you that a little bit of planning helps these people get more money in retirement. You can see just a little bit of planning, that's a $300,000 difference. Now, I will tell you on all of these things, everyone's taxes situation is different. Somebody's going to come up after me and say, listen, I know if you go early, it's less, and if you go late, it's up to 70. That's great. What is the optimal age? So let's just tell you, when we run software and say, when is sort of the break-even time to collect Social Security, it depends on your life expectancy, really. So the software will show if you live to 77 and you die before 77, if you're on 77 or earlier, you're better to go early. Collect your Social Security benefit. You win. But if you think you're going to live into your 80s and you go early, you're going to leave a lot of money on the table. A lot of money. So again, we don't know, right? And by the way, remember that delay, Social Security to 70? 62 to 70. Remember, I had somebody come into my office and they were 72 years old, 2 days before their 72nd birthday. He did not turn on the Social Security benefit. I asked him, how come you didn't take your Social Security benefit? Now, this guy's got money, so he's not missing it. Why didn't you turn your benefit on? He said, I'm waiting until 72. He said, that's when you can max the Social Security. I said, who told you that? He goes, my brother. And of course, you know me. Your brother works for Social Security? No, Tim. He's got this franchise over here. Here's the difference. I said, well, listen, you don't get any more money than you would have got if you turned it on in 70. And oh, by the way, these 2 years, when you go to turn it on, they do not backdate these 2 years. They do not backdate these 2 years. You just lost 2 years of income. So just understand 62 to 70, that's how that has to work. You think you're going to get advice. How many think you can go to the Social Security office and they're going to give you advice on planning this? How many know? This is from the handbook. If you work for Social Security, right out of their handbook, you can give people enough information, tell them what their dollar amounts if they want to turn a benefit on the day you walk in, but you cannot give any advice and you cannot do any planning. What does that mean? You're on your own. And you're lucky where you find the information to know what happens. Most people want to know when they run out of money, so the last 5 minutes I want to talk to you a little bit about, as an advisor, some things that I would have you consider the same way I would talk to my own clients when you're talking about Social Security and retirement income. Remember, we talked about that accumulation. We're going to talk now about distribution phase. You're going to pull money out. How long will my money last? Well, now a market correction is going to matter to you when you're pulling money out. It's a little different. Your health. I have a heart attack or a stroke. I'm going to pull money out, taxes. You can talk about this. So we want to talk a quick second here, and I would have you think about which egg do you crack first when you go into retirement. This is the secret to retirement planning that really gives people peace of mind in retirement. I find that the people that are in retirement that are really enjoying retirement are the ones that have this all out with guaranteed money, and they know where their money's coming from and they're not worried. They have money invested, but they're not worried up and down because that's not all their money. So we want to get people to where they're enjoying retirement. So just a quick thing here to think about. I'll tell you a couple of slides here. Social Security is a guaranteed income. You're going to get it for the rest of your life. If you got a pension, guaranteed for life. Now what you have to know about a pension is if you die, does your spouse get half of the pension, all of the pension, or none of the pension? All pensions work different. But if you are getting a pension, that's guaranteed for life. Well, Tim, I got an IRA and I got all these investments. Is that guaranteed income for life? How many say yes? I would say, I have people come into my office when they got their 401k. So just understand how we all started with this. How many have a 401k or anything like that at work? Okay, so you're going to understand this. So when you were working and you were contributing, remember they passed around a little sheet. And they said, hey, you choose what kind of buckets you want to be invested in. Do you remember signing those pages? So you kind of end up with 60% of your money's probably somewhere in some stocks, maybe mutual funds or whatever, and 40% of your money's probably in some bonds. That used to be the model, 60-40. That is a long-term horizon, 30-year way to go. Now, when people retire, they stay in that 60-40 model. That's a death zone. We have a market correction today. How many remember 2008? Anybody remember that? How many would like that to happen when you're 70 years old and half your... We had a little hiccup today. How did that feel? The market was not doing well today. I had people calling me. Anyway, the point is, we're going to talk 2 minutes about your investments. I'm going to make sure you get this. People will ask me, well, what kind of money should I be taking out of my retirement accounts to live my lifetime? So you can talk to whoever you have as an advisor, but I would think the general rule with everybody, this is kind of how we're all taught, we're going to probably recommend around 4%, right? Don't you hear this all the time? Now, this is 4%, but that's not subject to taxes, and that's not subject to any market correction. This is hoping everything's doing great. We're all going to do just great. So think about this. If you got $500,000, that's 20 grand a year. Now, if you have $1 million, it's 40 grand. So it's a little bit different, but this is still subject to taxes, subject to market risk, and what happens if you have a stroke and you don't die or you have a heart attack? How many think Medicare is going to take care of the nursing home for you? Not. So let's just talk about qualified money. I think you should understand this. When you leave here, you need to know this is going to matter to you. Qualified money is a 401k, an IRA, a 403b, a SEP, 457, money that you've contributed for retirement that you've never paid tax. Everybody with me on here, you make a contribution at work to your money. You don't pay any tax, correct? That grows over 30 years while you're working. When you pull the money out, do you pay the tax on this or do you pay the tax on this? How many know? You pay tax on all of it, correct? It's a shocker to people. They come in, they got $500,000. I say, well, you got $350,000. What? Well, remember, you got tax. Oh, what? Tax dependent. Listen, it gets to be a little confusing, and I'm going to explain a few things to you. But qualified money, a couple things you need to know. One, when you're putting this money in and you're not paying tax, now obviously you're hoping that when you retire, you're not making the same money, you have a lesser tax bracket, so obviously when you're pulling that money out, you're paying less, but I'm going to show you how taxes really eat up people in retirement. First thing I'll tell you about, you have a 10% penalty if you have a qualified account and you pull the money out before 59 and a half. How many understand that? And isn't this funny? 59 and a half. 59 and a half. I don't know where they come up with that. But what people, everyone kind of has a good feeling about this and understands this, but what people don't really understand is this is an RMD. When you turn 70 and a half and you have a qualified account, whether you want to or not, the government's going to make you. How many know about this? They're going to make you take what's called an RMD, a required minimum distribution. What are you telling me? They're going to make you pull money out and pay the tax, and every year make you pull money out and pay tax for the rest of your life. Why? Trillions of dollars are in these accounts. Nobody's paying any taxes. Our government is kind of broke. How many know this? You think they're like anxious for the money. If you don't pay this money, now by the way, this is at 670 and a half, you got to take 3.65. So if you had $1 million in qualified money, you got to pull 36,500 out of that account, pay the tax. Next year it goes up. You got to keep pulling this money out. What is the penalty if you don't take an RMD? 50%. What? So if you were supposed to take 40 grand out of your account and you don't, now you got to take the 40 plus another 20. Where I want you to understand something here that's very dangerous is when you're pulling money out of an account, pulling out to live on and paying a tax, and maybe having to pay more money out, and the market could be dropping while you're pulling money out, I want you to see how fast money disappears. Before, when the market was down, you were putting money in. So after tax contributions, RMDs, now remember, the one thing I want to tell you about this, a Roth IRA, if you have a Roth, that means you took money out of your work, you got a paycheck, you paid tax, and then you made the contribution. That money, when it grows, you never pay tax on it. So everybody likes the Roth. Like me and many people, we didn't do enough Roth when we were planning. So later on, and by the way, the Roth has no RMDs or no income tax due. Can you convert money later after you retire? And the answer is yes. And the only thing I want to say about this is if you have qualified money and you want to convert some of that money to a Roth IRA, there are no limits. There's not the same limits when you were contributing when you were working. Not suggesting this, but if you had $500,000 in a traditional IRA or a 401k and you want to convert all $500,000 to a Roth and you could pay that tax, you could do the whole amount, pay the tax, and you'd never pay money on that tax on that money again. We suggest you do it in pieces, but we do a lot of Roth conversions. Why? Because we want more money in retirement that there's no tax. Social Security is no tax. Roth money is no tax. People live a little bit better this way. Let me say one thing about risk in retirement before I lose my voice. Been doing these things all week. Remember this market. Sometimes we forget. Remember this was the 90s. We were all laughing, right? And then, 2000, 2001 happened. Remember that? That was about 40%. They said, that won't happen again. 2008, it went down 50%. How many remember these? So let me ask you in retirement. We've been on this 9 or 10 year bull run right now. Market's going fantastic. How many think that's just going to keep going up and up and up all the way into your retirement? Do you think that? I don't. Do you think we could have one of these again? I think so. Would it matter if you were 80? Maybe not. If you were 70? I don't know. But it's more severe the older you are when you lose half of your portfolio. Everybody gets that. Don't let any advisor pull wool over your eyes and tell you stuff like this. They just want you to know. If you lose 40% in your portfolio in the market, and then that market comes back years later and you say, okay, your advisor calls and says, you're 40%, we made 40, we're back to even. How many know you're not even? You lose 40, you got to make 66 back in gains to get even. You lose 50%, you got to make back 100%. Here's my point. If you lose 50% in retirement and you're pulling money out, and now you got to make 100% in gains, that could take 10 years, 11 years to get back to even. This is serious stuff. You got to really talk about how your asset allocations are a little different when you start moving into retirement. It matters. If you don't remember anything, remember this last slide. This is going to show you something that we look at all the time. So to explain this is the same portfolio. Portfolio A and Portfolio B started with the same amount of money, about $500,000. They're pulling $25,000 a year out of this account. So just so you know, that's not a lot of money. Both of them are doing the same thing. They're pulling $25,000 a year out. They're both averaging an 8% a year over the time. Everything's the same, right? Well, how come one person is out of money at 81? They have 82 years old, broke. How come this person's got 2.6 million at age 90? If it's the same, what's different, right? Here's what's different. If you can see 3 negative market losses in a row, boom, boom, boom. Can that ever happen? That's happened twice. Shame me once, shame on you, right? Shame on me. Remember that little story? This has happened a couple times. So what happened is this person lost money big right at the beginning, was taking their money out. Look at that. They'd never recovered in that portfolio. This person made money right away. We flipped them. We took this and flipped it upside down. Their losses are at the end. So the point being that later in life, and you got a lot of money, your time horizon's different. Here's the point to this. You're working, you're saving money, you've got these accounts, you've done well. You're getting ready to retire. Do you want this money that you saved up to start disappearing right when you want to start living on it? I want you to know that you have some rules for you if you're at work and you have a 401k or a 403b or some kind of a qualified plan at work, and you want to take some of that money out and put it into an IRA or an investment that's protected, you can if you're 59 and a half, even though you're still working. Why is this important? Because you don't want to say in 4 years or 3 or 4 years I'm going to retire and it could get lost in the market before I even get my hands on this money. One of the things that we do, and we would be happy to do this for you, I do this with my clients. They come in with their 401k or whatever assets they have from wherever they're at, and they show me all the things that they're invested in, and I put it into our software. And we run this thing called the stress test. It actually just takes everything that you're invested in, you'll be surprised, and we say, okay, and this is Morningstar data. This is not Tim making some up. We just go right back and say, let's go back to 2008, and we say, your portfolio, if 2008 happened again to you today, what would happen? Showed this to somebody today. 47% of their money would be gone today. And I said to them, how do you feel about that? He said, terrible. How would you feel if you lost 47%? So what are you doing about it today to protect it? That's the question. Anyway, I'm going to tell you about one thing. We do other things, but this is the last slide I will tell you. I want you to think about this. We offer our clients something called a risk-free, a market risk-free account. This is where you can put money and you can never lose a dime. Now, it works like this. If this was the stock market bouncing all over and you're invested, the indexed account is based on an index. So you're going to grow your money based on an index. Could be an S&P 500, could be a Dow, could be a NASDAQ, could be whatever. But you're following an index. And what the one catch on this, people say, okay, so what's the catch? You can't lose any money ever? Will not lose money. Many of these accounts have no fee, but the catch is you don't make all the gain. So if the market goes up 10, you might make 5. But if the market drops 30 tomorrow, your gain and whatever you had stays level. So the green line is showing that you made money, and if the market drops, you don't lose a penny. If the market rebounds, you're going to make money. If it drops, this is a nice place for people to put some money in retirement. We are having people take some of their 401k, some of their retirement money, and moving it into these accounts before they retire. Why? Because they don't want to have this thing correct right before they're going. If you're interested in this, you can come on in and talk to us about this. We also are taking retirement funds and saying this is kind of how clients are setting up for retirement. Social Security money, He's got a pension, she doesn't. We took some of his 401k money, got a guaranteed income for life out of his 401k. Some of his money, that's guaranteed. That's guaranteed. So we went from $3,600 a month to $6,100 a month, guaranteed till they die. These are a couple things that you should talk about if you're looking at Social Security. I find that sometimes people get to this age, they're not really planning retirement, they're not thinking about it. They're spending more time planning the family vacation than they are in retirement. But I want to tell you, I'm in this business every day, folks. This is serious. I'm watching this with people. I see this every day. My advice to you would be, if you're looking at this and you want to have a closer look, I'm going to pass around a little evaluation form here. This is a form I would just ask that if you could fill it out for me. It's an evaluation. So you can give me some information there. If you give me your name and your email and stuff like that, you'll get some emails from us and different things that are coming up. You can rate me from 1 to 5. If you think I was pretty good at this, you can give me a 5. If you think I stink, you can give me a 1. But I would ask everybody in here to please fill this out because it helps me get more talking engagements like this. So just appreciate that. You may be interested in the indexed account or some of the things that I just mentioned here. You can check the box, and if you want to come in and talk to us, you can put down the information here and say, yeah, you're somebody I want to come in and talk to us. By the way, that's a free strategy session. You come on in, we have a conversation about anything that this talk about, it's just free. But sometimes people want to come on in and just talk a little bit and maybe see if there's something they can do. You fill out the information. If you want somebody from my office, a guy named Craig, he will call everybody from here. And if you wanted to come in and talk to me, he'll set up a time for you to meet. Okay, just so you know. Please have just a chance to fill this out. Before you leave, if you could just pass it, come on up here and give it to me. I'm going to pass them out, and then I'm going to be up here to answer any questions. If you have questions, come on up, and I'll make sure that I answer any of those questions, okay? Thank you.